Hello everyone, my name is Shubham Jain, and as discussed, I'm here to tell you guys about basics of Indian taxation. So I'm going to brief you about how the taxation in our country works and what are the basics of the taxation, how to file your ITR, what are the things that you require to file your ITR, how the total income is being calculated in India, what are the steps that we require to calculate. बहुत basic बताऊंगा. Let us start with the basics. First of all, what is the meaning of tax? As every one of us know, tax is the cost of living in a society. Government needs tax, government needs revenue, government needs to meet the common welfare expenditure of the society, as you can see on the screen. So basically, there are two types of taxes. One is the direct tax, and second is the indirect tax. Direct tax and indirect tax, the difference between direct tax and indirect tax is that direct taxes are directly levied on the person, and indirect taxes are indirectly levied on anyone. Indirect taxes includes goods and service tax and custom duty. It is basically for the businessmen, people who supply goods and services, people who do business. And direct taxes are levied on everybody, be it a person, be it a salaried person, be it a person who is having business income or anyone who is having income. Direct taxes are levied on everyone. So in direct taxes, there are two types of taxes: income tax and tax on undisclosed income. So basically, we are going to discuss about income tax part today. So first of all, let me tell you the concept of previous year and assessment year. In our country, year for the taxation purpose is from April to March. Like for example, this year, the financial year in which we are, it is started from April 2022 to March 23. Whatever will be the taxation will be calculated from this particular month, April 2022 to March 23. This is known as previous year. Now the assessment for this income, assessment for the incomes earned in this particular year, the assessment for the incomes or the deductions or everything for this particular year will be done in next year, starting from April 23 to March 24. That is why the assessment year for this particular year is called assessment year 23-24. So this is called the financial year, and the assessment as it is done in the next year for any particular year. That is why the assessment year for this financial year is always called as assessment year 23-24. So in terms of taxation, in the terms of taxation, in the terms of law, we refer this particular year as assessment year 23-24, because the assessment of all the incomes of this particular year will be done in the next year. Similarly, the next financial year 23-24, the assessment year for next financial year will be assessment year 24-25. So that is how the concept of previous year and assessment year works. Now let us start with computation of total income, the part where we calculate the income. Now what are the steps that we require to calculate the income? किसी की भी income calculate करने के लिए क्या क्या steps होते हैं? Number one is determination of the residential status. As you know, in our Indian taxation system, there are 2-3 types of status. For example, resident and non-resident. We are going to discuss about this in detail in a few minutes. I'm just giving you an overview of this. The first step is determination of residential status. Resident के लिए अलग से calculation, non-resident के लिए अलग से calculation. Secondly, the classification of income under 5 heads. The income is classified under these 5 heads as shown on your screen. The first head is salaries. Whatever the people who are salaried employees, whatever they earn, the head in which their income goes is salaries. This is the first head in which we calculate income earned from salaries. Now we are going to talk about this in detail further. The second head is income from house property. If you are earning any income from house rent or any income from house property, if you own a house property and you are getting any kind of income from that, it will come under this head, income from house property. The third type of head is profit and gains from business and profession. Anyone who is having a business or profession and any income derived from that business and profession is going to come under this head. The fourth type is capital gains. If you are selling any capital asset, for example, if you are selling any property in a particular financial year, if you are selling any mutual funds, if you are doing a trading of shares and all the income or the losses derived from those particular sale or purchase will come under this particular head. And any other income that forms a part that does not fall under all these four heads will come under the head of income from other sources. For example, the income earned from bank interest, income earned from FD deposits, income if you are winning a show, like if you are winning something from KBC, you get some income, it will come under this head. Any particular income that does not fall into the above four heads will come under this particular fifth head, income derived from other sources. Now, a same person can have income from salaries, as well as income from house property, as well as income from a side business or something, as well as he could sell some property and could have income from capital gain. And also he can have income from other sources. We have to show, we have to compute income under each head. We have to show the income under respective heads. The next step is applying the clubbing provisions. Clubbing provisions, what do we mean by clubbing provision? Is that if we have a child, like if we have a son or daughter who is under the age of 18 and he goes somewhere and wins some kind of prize money, or if he is doing some kind of small business and is earning some kind of money, he is not liable to pay income tax, as he has not crossed the age of 18. He is not liable to make a PAN card. That is why the clubbing provisions attract. We are going to club the income of that particular child into the income of the father or the mother. So that is why if you are a father or mother and if you have a child and he or she has earned some income, the income of that particular child will be clubbed in your income. That income will be shown over here. The next step is set off carry forward of losses. For example, if you had some kind of losses in your past years, those losses will be carry forward in the next years, and it depends on scenario to scenario. Sometimes it is carry forward for 5 years, sometimes it can get carry forward for 8 years as well. So if you are having any losses of past years that are going to set off from the income of this particular year, so we are going to set off or carry forward the losses of past year or this year in the next step. After doing all these things, we arrive on the gross total income. The total of these steps will give us the gross total income. After having the gross total income, we are going to deduct the deductions under chapter 6A. These deductions include deductions from section 80C to section 80U. As you all know, life insurance and everything, it gets covered under these sections. When we deduct the deductions from the gross total income, we arrive on total income, and then the tax on this particular total income is being calculated and we have to pay it to the government. I hope this is clear till now. Now let us go into the details of all these steps. So first of all, we talked about determination of residential status. In our country, residential status is of three types basically. Firstly, there are two types, and then there are two subtypes of resident. One is resident, other is non-resident. And in resident, there are two types: resident but ordinary resident, and resident but not ordinary resident. It is known as ROR and NOR. So there are some kind of rules to determine a person will fall under resident or ROR or NOR or non-resident, and the taxation for that will be done accordingly. This is how we determine the residential status. First of all, we need to be clear a person is resident or not. For example, there is a small calculation of this. One of the calculations I can tell you that if a person is staying in India for 182 days or more, he is considered to be a resident for that particular year. And if he's staying in India for less than 182 days, he is considered to be a non-resident. But again, there are certain conditions to that. This is not the exact calculation. This is just an example. So if the person is a resident, we'll calculate the income according to resident provisions. If a person is non-resident, we'll calculate it according to that. The second is classification of income under 5 heads, as I told you. Salaries, income from house property, income from business profession, income from capital gains, and income from other sources. We will classify the incomes and we'll put the incomes under the respective heads. Third is income under each head. We are going to list the exemptions and deductions, then the clubbing provisions of this, then set off from carry forward of losses from each head, Like set off from salaries would be different than the set off from capital gains or house property. All the incomes cannot be set off from each head. Some incomes can be set off from interhead set off can be done for some kind of income, but all the incomes cannot be set off from all the heads. So that is how the set off provisions are applied. Then the computation of gross total income, as we can see, income computed under each head, then curbing provisions, then income from setting, then set off and carry forward of losses. Then comes the deductions. Deduction in respect of certain payments, certain incomes in respect of certain other incomes. Certain payments, deductions for certain payments means when we pay something and the government has allowed us to get a deduction for that, then we are going to say the deduction in respect of certain payments. For example, we pay the premium of life insurance and we get the deduction of that. Those are the deduction for certain payments. Similarly, there are certain incomes for that for which we can have deduction. Like if we are earning some kind of royalty income, the government has made a section in that we can get a deduction for that particular income. So that is how the payments and incomes we need to bifurcate them in each section, and we can get the deductions from the gross total income. And then there are computation of the total income. At last, when we get the total income, we need to calculate the tax, and we are going to see what are the rates that the government has prescribed to calculate the taxes. So as you guys can see on the screen, if a person who is having income up to 2,50,000 and is below the age of 60 years, the tax rate for that is nil. The government says you do not need to pay any taxes if you are having income less than 2,50,000 in a particular year. This is not monthly. Everything that is being calculated is for the whole financial year. In case of a senior citizen who is more than the age of 60 years but less than the age of 80 years, this 2,50,000 limit has been extended to 3 lakh rupees for that particular person. And a person who is above the age of 80 years, this limit is 5 lakh for it. That means up to 5 lakh, there is no tax for a person who is up to for above the age of 80 years. Then the next slab is 2.5 lakhs to 3 lakhs, as the case may be, to 5 lakhs, depending upon the age limit. The next slab is 5 lakh rupees. This means from 2.5 lakhs to 5 lakhs. This is the tax slab rate, 5%. Then the income ranging from 5 lakhs to 10 lakhs is 20%, and 10 lakh income earned above 10 lakhs is always taxed as 30%. Now, these are not the flat rates of taxes. These are always calculated step by step. First 2.5 lakh is exempt for everybody, be it a person who's earning 2.5 lakhs or 2.5 crores. First 2.5 lakhs is exempt for everybody. The tax on next 2.5 lakhs is 5%, that is for everybody. Then the tax on next 5 lakh rupees, like the slab rate of 5 to 10 lakh rupees, 20% slab rate is for everybody. And then all the people who are earning above 10 lakh rupees, 30% slab rate will be charged on the income that is above 10 lakh rupees and not the income that is below 10 lakh rupees. What I mean to say is this is not a flat rate of this is not flat tax rate system. This is slab wise. The tax is always levied slab wise. Just a second. Let us continue. After that, these are some surcharge provisions. People who are earning income more than 50 lakhs to 1 crore rupees, there is an additional 10% surcharge on the income tax part. Like first of all, we will calculate the tax, and then we will calculate the surcharge on that particular tax. 10% of this particular tax. Then the people who are earning income more than 1 crore and less than 2 crore rupees, the surcharge rate is 15% for them. Yani ki tax plus 15% of this tax. Then the people who are in the slab of 2 crore to 5 crore rupees, there is additional 25% surcharge, and above 5 crore rupees, people have to pay 37% of the surcharge of the income tax that is being calculated on their total income. After that, there are some kind of deductions for capital gains and all. We are gonna see it further. Then there is a rebate of up to rupees 12,500 rupees for any person who is having total income up to rupees 5 lakh. कोई भी अगर 5 लाख रुपीस से नीचे इनकम कमाता है तो उसको रिबेट मिलती है 12,500 rupees की, or the tax whichever is lower. So in a layman language, we can say that people who are earning up to 5 lakh rupees, they do not have to pay any taxes to the government, because whatever the tax is, like 5% of 2.5 lakh rupees comes to 12,500 only. So they get a rebate for this particular section only and only if their income is less than 5 lakh rupees. If the income is 1 rupee more than 5 lakh rupees, this rebate gets cancelled, because it is for the people who are earning income less than 5 lakh rupees. The total income for that particular person shall be less than 5 lakh rupees only to avail this rebate. So this is how we calculate. And then whatever the tax is calculated after surcharge, there is a 4% of income tax, 4% of cess, health and education cess, that is being levied. So you can see on the screen, total tax liability is equal to the tax on total income at applicable rates plus the surcharge if applicable. Like if the people are earning more than 50 lakhs slab wise, then less the rebate amount if the people are getting rebate, and then the 4% cess. That is how the tax liability of income tax is calculated. Now we have to file all these things in your ITR form. We have to file your income under the head salaries, and then business profession and house property. We have to bifurcate all these things. Then we have to calculate the deduction provisions. Then we have to calculate the capital gain provisions, and then we have to fill all these forms in an ITR. What is ITR? ITR is the form in which you tell the government that I have earned this particular income and this falls under this particular head, and then you calculate the tax according to these given slab rates, and then you pay the tax to the government in that ITR. The ITR is income tax return, that is the computation of your income for that particular year. And everybody in this country who is earning income more than 1,000 rupees is liable to file an ITR. This is something that you cannot ignore. You cannot say that what if I will not file an ITR. There are certain provisions which tell us the amount of penalties and the amount of the time of imprisonment that are prescribed in the Income Tax Act for not filing of an ITR. But obviously the government is not so much harsh on people. What the government says is, if you are not filing an ITR, you file it. If you get delayed in filing your ITR, you need to file it with late fees or penalties, but you have to file it. That is your statutory liability. Only deduction of the TDS is not enough. Filing of the ITR is mandatory for everybody. Now I'm gonna tell you, like, most of the people who are over here who have joined us are salaried employees. So I'm gonna tell you a detailed provision on how we calculate income from salaries, particular head salaries. We are not gonna discuss about the other particular heads. I'm gonna give you a brief of other particular heads also, but for salaries I'm gonna tell you each and everything. Now these are some new rates that Income Tax Act has prescribed. Like you can see on your screen, up to rupees 2,50,000, the rate is nil. From 2,50,000 to 5 lakh, the rate is 5%. From 5 lakh to 7.5 lakh rupees, the rate is 10%, and so on. Now these are some rates that the government has prescribed, the new rates under section 115 BAC. Now the government says you can opt for these new rates as well. But the condition to opt under these new rates, the condition to file the ITR with these new rates, or the calculation of tax with these new rates, comes with certain conditions. The conditions are that you cannot avail the benefit of any deduction. You cannot avail ATC deduction. You cannot avail ATD deduction. You cannot avail any deduction that the government has prescribed. And once if you have opted for this particular section, you cannot revert it. Now you have to file your ITR in this particular section for the whole lifetime. Only one option has been given to salaried employees to change from new scheme to old scheme, only once. But if you have opted for it, you cannot revert it back. So that is why this is the new section. These are the new rates that is applicable. Now I'm going to tell you about the computation of income under the head salaries. Salaries, particularly salaries को calculate करने के लिए क्या क्या salary income हम लोग लेते हैं and salary के अंदर कैसे हम calculate करते हैं. First of all, the first step is calculation of basic salary. Whatever the basic salary that you are getting is being written. Then the second step is fees or commission if you are getting any commissions that is being added into it. The third is any kind of bonus if your company is giving is being added into it. Now the fourth is allowances. There are different kind of allowances. You all must be familiar with it. First is dearness allowances. Straight away we add the dearness allowance. The second is HRA, house rent allowance. Now many people get confused in this particular allowance, HRA. HRA received is not exempt fully. We cannot exempt the full amount of HRA until and unless we justify the calculation that is being given on your screen. Now look at the calculation. First of all, we write the amount of house rent allowance that is being received by us. The company जितना भी हमें HRA देती है, first of all we write that. Secondly, we exempt the amount that is least of the following. These are the 3-4 things that are given. We are going to exempt the amount that is the least of the following. The first thing is HRA actually received. The second is rent paid over 10% of the salary for the relevant period. For example, if your rent is 1 lakh rupees, if your salary is 1 lakh rupees, and if you are paying rent 50,000 rupees for the whole year, so 10% of this salary is 10,000 rupees. Rent paid over 10% of salary is 40,000 rupees. So this amount comes to be 40,000 rupees. In second, we are going to write 40,000 rupees. The third is 50% of the salary if accommodation is in Mumbai, Kolkata, Delhi, or Chennai, and 40% if it is in any other city. Out of all these three, whichever is least is going to get exempt from the actual HRA receipt. And then we are going to minus it, and then we are going to write the balance amount over here. That is how the calculation for HRA is done. Not in every case, it does not happen that the full HRA gets exempt. There is a particular calculation for it. We are going to calculate the exempt amount of HRA, and the amount that is being exempt according to the calculation gets deducted from the actual HRA received, and then we are going to add that value. Third is children education allowance. Now the government is allowed only 100 rupees per month per child up to maximum of 2 children. If your employer gives it. Children hostel allowance, transport allowance, and entertainment allowance, and there are various other allowances. Now there are perquisites, taxable perquisites such as rent-free accommodation. Whatever we are getting as rent-free accommodation, we are gonna add it. Now accommodation provided by the government to its employees. This is in the case of government employees. There are certain calculations to calculate this. Now the calculations include cities having population more than 25 lakh rupees, cities having population from 10 lakh to 25 lakh, and various other calculations are there to calculate this amount. We're going to add that amount after all these calculations. Then obligation of the employee discharged by employer, if any, we're going to add that. Sum payable by employer to effect an insurance, we're going to add that. There are number of perquisites and allowances. We're going to add everything, and then we're gonna reach at the point where we get the total amount that is being earned under the head salaries. It also includes uncommuted pension and leave encashment. All these things are included in salaries. This is the gross. We reach the amount of gross salary after adding all these allowances and perquisites from your basic salary. Now the government says under section 16IA, the amount of salary shall be deducted from an amount of rupees 50,000 rupees for everybody. Any person who is getting salary, the government says we are going to give 50,000 rupees as standard deduction to every person who's earning income under the head salaries. Then we deduct the amount of 50,000 rupees from this gross salary. Then this is for government employees only. This is irrelevant for now. Whatever the professional tax is being deducted, we're going to write here, and then at the end, this is the net salary that is being computed, and the income, the tax that is the tax that will be calculated will be on this particular salary. This is how we calculate the income under the head salaries. Now similarly, if I tell you a brief about house property, if you are earning any income from house property, rent, for example, rent received in a particular year is 1 lakh rupees. The government says we allow under section 24A flat 30% deduction from this particular amount of rent received. Now, to calculate the rent received, there are various other provisions to calculate how much rent has been received, to calculate the ownership of the let out property, self-occupied property. There are a number of provisions, but we cannot discuss all the provisions over here right now. To tell you a brief, I'm telling you rent received minus 30%. This comes to be 70,000 rupees, flat 30%. No deductions are allowed after this particular deduction. You cannot claim any deduction of repair and maintenances from the income under the head house property. You cannot claim any deduction of construction. You cannot say that I have invested 25 lakh rupees in the construction of my house, so I need to get a deduction from this. No deductions after this 30% is allowed. The part where you can get your deductions and repairs and maintenance allowed comes under the head of capital gains. I'm going to tell you about that also. Then after this 70, after this flat deduction of 30%, if you are having any housing loan and you have paid any interest on that particular loan in this particular year, the amount of interest paid in this particular year for this particular property from which you are earning rent can get deducted under section 24B up to rupees 2 lakh in a particular year. And also the principal repayment for this particular home loan can get covered under section 80C, which we are going to discuss later on in the part of deductions. So this is how we calculate the income received from house property, flat 30% under section 24A and up to rupees 2 lakh rupees in 24B if you have taken any housing loan. We are not talking about LAP, we are not talking about personal loan, only housing loan if you have taken, and the interest part of that up to rupees 2 lakh rupees you can claim deduction under the head house property. Now the third is capital gains. The third is business profession. Now, as we know, to calculate the profits, to calculate the losses of business profession is not an easy thing. All the people who are doing business, all the people who are doing profession, they need to get through a lot of provisions to calculate their profits and losses. To tell you a simple, we need to maintain a profit and loss account. We need to prepare balance sheet. We need to arrive at net profit or loss for that particular business, and that amount gets added over here in the head of business and profession. The fourth is capital gains. If you have sold a property in a particular year, for example, you file the return for this particular year and you have sold a property for 1 CR or 1 crore rupees if you have sold a property. Now, in this particular section, the government says the time when you have purchased the property, like if you purchase the property in 2001, you need to get indexation done. Indexation is something like in 2001, the thing that was for 100 rupees is now for 331 rupees in 2023. And these are the government prescribed rates. These are the chart. This is a chart that is being given by the government, that according to this, you need to go through the indexation. Like if my value of my property was 50 lakh rupees in 2001, I am going to calculate the current value of that property, and I'm going to minus this from this particular sale price, and whatever I derive from that will be the income under the head capital gains. And on this amount, I will be charging 20% of the long-term capital gain for this particular property. Now, the part where you can get your deductions of the construction or repair maintenance of your property, of the amount that you spent on construction, repair, maintenance. This is the part in calculating the capital gains. You can also claim deduction for the amount of repairs and maintenance done in particular years, and calculate indexation for those particular years, and then you can arrive at the amount of capital gains. And the income under the head other sources, the last head. Bank interest earned, FD interest earned, lotteries, winnings, or any other comes under the head of other sources. This is how we calculate the income from other sources. Now, let us come to the part of deductions. So everybody of us, all of us must be familiar with this particular deduction. As you can see on your screen, deduction of ATC, which is applicable for individual and HUF. HUF is a different concept. We'll learn about it later on. Any person who has contributed to PPF or LIC. Now you can see what all things are covered in ATC. Life insurance premium, contribution to PPF, superannuation fund, repayment of housing loan taken from the government, as I told you earlier. Tuition fees, like if you have a child and you're paying tuition fees for his education, gets covered in this. Term deposit for 5 year FD, इसको बोलते हैं. Subscription to notified bonds of NABARD, 5 year post office time deposit, senior citizen savings scheme account. Any deduction, any contribution made to these particular things, you will get deduction of rupees 1,50,000 for all these contributions made. Not only for life insurance, not only for PPF, but in combination of all these things, you will get maximum deduction up to rupees 1.5 lakh rupees. It is not like if you have if you have paid a premium of rupees 1.5 lakh rupees, and if you are also giving tuition fees of 1.5 lakh rupees, you will get 3 lakh rupees deductions. It does not work like that. The maximum deductions you can avail in any of these heads is up to rupees 1.5 lakh rupees only. This is the head of ATC. The second important head is ATD for medical insurance. Like if you're having a medical insurance and if you're paying premium for self, then you can have a maximum deduction of up to rupees 25,000 rupees for that particular mediclaim, and 50,000 rupees in case you are paying the premium for mediclaim of your parents. If you have paid the premium from your particular account for your parents in a particular financial year, then you can claim deduction apart from this 25,000 rupees of rupees 50,000 rupees in your ITR. But the condition is that you need to pay it from your particular account for your parents only. Then only you will get this deduction of 50,000 rupees in your ITR. This is the basic of ATD. Then there are various other deductions such as ATCCC, contribution to certain pension funds, ATCCD. This all gets covered under ATC only. ATDD, this is a calculation for maintenance, including medical treatment of dependent disabled. It means a person who is disabled and is dependent on you. Like if you are taking care of that particular disabled person, and the definition of disabled in the income tax law is like a person who cannot walk, a person who is not mentally stable, and there are various other conditions for the definition of disabled, and that type of person is dependent on you. And if you are taking care of that particular person, you get a flat deduction of 75,000 rupees. And in case where the person is severely disabled, like with 80% disability, as you can see on screen, you can get a deduction of up to 1,25,000 rupees under section 80DD. Meaning of dependent is also shown over here. We're going to discuss it later on. ATDDB is a deduction for medical treatment of specified diseases or ailments. For example, if you are paying certain sum to cure specified diseases. Now, specified diseases are those diseases that are mentioned in the Income Tax Act. Not all diseases are covered under specified diseases. It is not like that कि बुखार हो गया तो आपने ये वाली deduction claim कर ली है उसके लिए. Specified diseases, there is a whole list for that. You can claim deduction up to rupees 40,000 rupees and 1 lakh if the payment is for medical treatment of senior citizens. This is only for parents. If you are doing this treatment for your parents, for himself or his dependent being spouse, children, also you can claim for yourself also. ATDDB. Now ATE is a deduction in which interest on loan taken for higher education. If you are taking any loans for higher education and if you're paying interest on that particular loan, you can get deduction under this particular section, which is ATE. Now ATEEE is deduction for interest on loan borrowed from any financial institution for acquisition of residential house property. But this is a condition where you are not getting any HRA. You can claim deduction under section 80EE. Then there are various other deductions such as 80EEA, also 80G. 80G is an important deduction in which if you are donating any sum to certain charitable institutions as mentioned on your screen, like Prime Minister National Relief Fund, you can get 100% deduction for that. Like if you are paying an amount of rupees 1 lakh, you can claim full 1 lakh rupees deduction if you are giving donation in these particular accounts, and 50% of the deduction if you are giving in any other charitable institution, NGO, any trust who is liable for 80G. Now the other important deduction is 80GG, rent paid for residential accommodation. This is also individual not in receipt of house rent allowance. This is 80GG. 80GGB is a deduction in which if you are contributing anything to the political parties, any amount, be it 1 rupee, be it 1 crore rupees, any amount to paid to the political parties is fully exempt, and you can claim a deduction for that particular amount in your ITR. 80GGC is any person other than local authority who is contributing to the political parties. Then there are various other deductions such as 80JJA, NSSE to whom section 44AB applies, whose gross total income includes profits and gain derived from business. This is something for the businessman. And 80QQB, royalty income, if you are earning income up to rupees 3 lakh rupees by royalty, which is your royalty income, is exempt, and you can get a deduction. You can claim deduction for that particular income under this section. 80TTA is an important deduction of interest earned from saving bank account. If you are earning bank interest up to rupees 10,000 rupees in a particular financial year, you can claim deduction of 80TTA under this section of rupees 10,000 rupees. Like if you're earning 15,000 rupees, you can get 80TTA of 10,000 rupees. Only 5,000 will be taxable. 80TTB is for senior citizens. They can get the same deduction up to rupees 50,000 rupees. 80U is a deduction for a person who is disabled, or deduction in case of person with disability, again 75,000 rupees and 1,25,000 rupees. So this is how we deduct the deductions, and then we arrive at total income after deducting all the deductions, and the tax on that total income is calculated and the tax is paid. Now, what is the concept of TDS? I'm going to explain you the little concept of TDS. TDS is something that your employer deducts. It is a tax deducted at source. It means that whatever he's paying you, if he's paying you 1 lakh rupees, he will deduct the tax on that particular income and he will give you the balance amount. Now he is deducting this TDS because the government has made it mandatory for this particular person to deduct the TDS and to give it to the government on behalf of you. But this does not mean that he is filing your ITR. No, you have to file your ITR on your own. You have to show whatever you're earning, and you have to claim that whatever the tax calculation is, less the amount of TDS, and if anything is payable or if anything is refundable, you can get it from the government on filing of your ITR. Your employer does not file the ITR for you. He just deducts the amount of tax. He just calculates the amount of tax. Also, he calculates the amount of tax on the income that he knows. Maybe you are earning any other income. Maybe you are getting any deductions which he doesn't know about. Maybe you are having, maybe you have taken some kind of loans which you have not declared. Maybe you could get some kind of deduction, but the employer does not know about it. He will calculate the tax according to the knowledge and the information that he has, and the amount of TDS he will deposit to the government on your behalf, but he is not filing the ITR for you. You have to file your ITR on your own. That is a mandatory thing for you, and you need to get it done. Now, if your tax is 1 lakh rupees, example, if your tax is 1 lakh rupees, and if your employer has deducted tax of 1,10,000 rupees, there is no need to worry at all. You file your ITR and you can claim a refund of this 10,000 rupees in your ITR. The government will give you the refund, but you have to justify that particular tax, that particular income. Similarly, if your employer has deducted a tax of 1 lakh rupees and your tax liability is for 90,000, your tax liability is for 1,10,000 rupees. The excess amount of 10,000 rupees you need to pay it to the government. That is how the TDS provisions are calculated. So I think I've made it very clear how to calculate the total income, what are the steps that are involved in total income, calculation of total income, what are the deductions, what are the mandatory things that we need to do to file an ITR, and how the deductions are calculated, all the TDS provisions. The employer that deducts the TDS for you is has been given the authority by the government to deduct the TDS only and not to file the ITR. The ITR you have to file it for yourself.